webinar series. My name is Mark Benzaquen. I am an instructor here at OIC. And before I begin, I want to thank you all for attending, not only for attending today's session, but those of you that joined us last week. And I also appreciate all of the well wishes and kind thoughts that you had sent my way. I am happy to report that my wife and I are both feeling much better with our COVID situation that we had last week. So luckily we're healthy, we're happy, and I'm certainly very eager to present to you hopefully a webinar that I think you're going to get a lot out of. It's one of my favorite strategies. One of the things that I love about options is their diversity and their many uses for options, the versatility. And one of those uses that people use options for is protection. So for those of you that joined us last week, we discussed the protected put, and now we're going to take that protection one step further with the options collar. Before we get to it, again, our disclaimer: options involve risks and may not be suitable for everyone. The calculations and the examples that we're going to be using today aren't going to include real costs that may impact your trade, such as commissions, fees, margin, interest, etc. And then again, the strategies that we're discussing today are simply for educational purposes. Some of the trademarks that you're going to see throughout the presentation, both for OCC and OIC. And speaking of OIC, for those of you that are joining us for the first time, we are a professional organization where we provide free and unbiased options education. We do that mainly through our website, optionseducation.org, where we've got interactive online courses, podcasts, videos, and webinars. As a matter of fact, we are going to be releasing a brand new course by the end of the month, fingers crossed, which is going to be all about different buying option strategies, whether you're bullish, bearish, or if you're expecting a big move in the market one way or another. So we're going to talk about all different types of buying strategies and break those down for you. We also have the pride and joy of OIC, which is our investor education team. And I'm lucky to have two of my colleagues, Romo Caldwell and Ken Keating, behind the scenes. So if you have questions during my presentation, feel free to send those in the Q&A console. Ken and Romo will be responding to those throughout the presentation, and then I'll be doing some live Q&A at the end. So please make sure that you send those questions in to us today. If we don't get to your questions, or if you come up with questions after the presentation, please feel free to reach out to us via email at options@theocc.com or live chat with us on our website. So that being said, let's go ahead and get right into it. Here's our outline for today. We're going to begin with a review of what we spoke about last week, the protected put. We're also going to do a high-level overview of the covered call. Those two strategies together, combined, equal the options collar. So we're going to talk about protected puts, covered calls. We're going to get into the collar, and then we're going to look at a couple different variations of the collar. Remember, I was talking about the versatility of options. So not only do we have an options collar, but we've got different variations based on different needs, wants, risk tolerance, etc. So we're going to talk about the staggered collar, a put spread collar, and a laddered collar as well. We're going to finish everything up with a Q&A session. Again, if you want a copy of the slides that we're presenting today, you can download those right on your console, or feel free to shoot us an email, and we'd be happy to send a copy of those off to you. So let's go ahead and get started. We've got protected puts, again, which we covered last week. The options collar, as I mentioned, is really two strategies in one. We've got the protected put, which is for downside protection. If you remember last week, we talked about various scenarios where maybe you were long stock and you're bullish on the stock, but the idea is that maybe you're cautious for one reason or other. Maybe we're entering an earnings season. Maybe there's a drug trial that the results are about to be announced, or a government contract, something like that. So the idea is that you're long the stock, you're bullish on the stock, you want to continue owning those shares, but just in case things go south on you, you want some protection, and that's where that protected put comes in, because it provides that protection against the decrease in that stock price. Now, keep in mind that your risk is still in, well, theoretically, your risk is in that stock, but with that put, it's giving us that exit point. It's giving us that exit price at which we can sell the share. So typically, we might select an out-of-the-money put if we own stock at, say, $100, and we're worried about it dropping down to $95 or below. We would buy, theoretically, an out-of-the-money put, maybe a 95 strike put, 96 strike, something like that, and that gives us the right to sell those shares at that strike price. But the good thing about the put, and if you remember last week, we compared it to stop loss orders. The good thing about the put is because we're buying the option, we are in the driver's seat for what comes next. And what I mean by that is, again, our example, we've got stock at 100, and let's say we want to exit it maybe at $95. Well, if we wake up the next morning and stock is trading, say, 94, but we've got another 3 weeks until our put expires, we can choose at that point, that next morning when we wake up, we can choose at that point to exercise our put if we want, but we retain that right to sell stock at $95 until that contract expires. So if during that 3-week period stock rallies back up to $100 or 110 or 98 or what have you, we have the control as to whether or not we want to exercise. Unlike a stop loss order where that loss is triggered once the share price breaches our limit price or our stop loss price, I should say. So because we're buying options, we're in control. We still have that potential to profit because if we don't need that protection, if stock goes up to $110 or $120 and we don't need that protection to begin with, we can simply allow that contract to expire worthless. So we're in the driver's seat. We control what happens, and that's where we get that last bullet point here. The long option retains the right to exercise. So that's where that comes from. Now, let's go ahead and take a look at it in a different version. Our structure is of a protected put. We're long 100 shares of stock. And again, we're typically long one out of the money put. We're looking for protection to the downside of our long shares. Now, here's something that I want to point out. Our forecast, we are bullish but cautious. We're looking for protection, but similar to car insurance, for example. I think I used that analogy last week. Similar to car insurance, we don't have insurance in that at the end of that 6-month period, we're upset because we didn't actually use that insurance. Remember, the point of car insurance is not to get in a car accident. The point of insurance is, should you get in an accident, this way you're covered. And obviously, while options and insurance are not identical, they're not similar or identical products, they are similar in the sense that they do provide us some degree of protection. So we're bullish but cautious. Just in case things go wrong, we want to have that protection. Our maximum risk is going to be our stock purchase price minus the strike price minus the premium paid, and we'll see that in just a moment. Maximum reward, that's going to be unlimited. We still retain those shares unless we decide to exercise and sell them. And because we are long the option, because we're buyers of the option, there is no assignment risk. And here's an example of a protected put. We're long stock at $60 a share. We're going to, in this case, buy the at-the-money $60 strike put for $1. Now, what that tells me with an at-the-money option versus an out-of-the-money option, this is saying, or this is telling me that the investor doesn't want to sell the stock below where it is currently. We could also purchase a higher strike, an in-the-money put, a $65 strike put, for example. That gives us the right to sell shares above where stock is currently trading. So that strike selection with the protected put and pretty much with any other option strategy that you have that strike selection is really paramount in terms of helping the investor determine what their risk is on this contract. So, for example, here we've got long.
Where? This right here? Oh, okay.
Roma, are you? Can you mute yourself, please? Sorry about that, everyone. So again, long stock, $60. We've got that 60 strike put for $1. This gives us our break-even point. Remember, it's going to be our share price plus the premium paid, so $61 is our break-even point. And the reason that is should we not need that protection, we're long stock for $60 to begin with, plus we paid $1 for that protection. If we don't need that protection, we've got $61 into the trade. So in order to profit on this trade, we're going to need share prices to finish above that break-even point. Our maximum loss is going to be our premium paid. So again, that's going to be, if we don't need that protection at all, we're going to simply let that contract expire, and we accept the $1 loss from the trade. So that's the high-level overview or a recap of the protected put, which again we talked about last week. Let's move on to covered calls. Now, it's interesting in this sense because typically a covered call, when paired with long stock, which is the definition of a covered call, it's a short call option paired with long stock. Typically with the covered call strategy, investors use it to generate some additional returns on their long stock position. That premium that they collect generates additional income, for lack of a better word, for the investor. So from the covered call by itself, again, long stock, short call, that short strike provides a ceiling for how high that stock can go, or I should say the ceiling is really how high we can profit once that stock increases in value. With the protective put, we're using the income or the premium received by selling that call, we're using that to offset the cost of the put. Just like the protective put, typically we use an out-of-the-money call in this case. That strike price determines where the stock may be called away. So if we think about an options collar, think about what a collar does, that it's protection for something. Some people talk about the protected put being the floor, and some people talk about the covered call part of the collar being the ceiling. So you've got a lower limit and an upper limit of where those share prices can go. If the stock price surpasses that short strike of the call, then our shares are going to be called away. And that's a risk that an investor has in generating that premium from the covered call to offset the cost of the long put. The offset or the trade-off is going to be that, well, now we're at risk of assignment, we're at risk of our shares being called away. So you can see there, again, that last bullet point, the upside profit is limited by the short call. Now, again, here's our table structure with the covered call by itself. Long 100 shares of stock, short one out of the money call, typically. Motivation, income, and increasing stock returns. That's the motivation for just the covered call, not the options collar. Forecast neutral to moderately bullish. Again, if we're aggressively bullish with this stock, then we're probably not going to want to sell a covered call against it because by choosing that strike price, that is that upper limit for where shares can go before they get called away from us. Maximum risk with the covered call is really in the long stock position. So it's the long stock minus the call premium we receive. Maximum reward is going to be the call strike plus the premium minus our long stock price. Again, we'll take a look at that in just a second. And assignment risk, central to the strategy. And the reason we say that is because the idea of a covered call, again, is that you want the share price to get up to your strike price. Let's say we're long stock from $50 we may be willing to sell it at $55, right? That's a 10% increase in the stock price. Plus, if we're collecting $1 or $2 premium by doing so, we've got an effective exit price or an effective selling price of our shares, $56, $57, which is, fairly significantly above where the stock is trading currently. So investors that do a covered call, they need to be willing to give up the shares if they get assigned. That's why the assignment risk is, in fact, central to the strategy. And here's an example. We're long 100 shares of stock for $52. We're going to go ahead and sell a $55 call against it for $1.75. Our break-even point is going to be the stock price paid, so that's the $52, minus the premium we receive, $51.75. 50 and a quarter is going to be where our break-even is. If we, as long as share prices finish above $50.25, you can see we're going to be profitable on the trade up until a maximum share price of $55. That's where our stock gets called away. So our maximum profit, if assigned, $55 is our strike price plus the $1.75 that we collected when we sold the call, minus our original stock price of $52 gives us a maximum profit of $475 or $475. So that's what the covered call looks like. We just covered the protected put as well. When we put the two together, we have an options collar. Now, why do people use a collar? Similar to the protected put, investors want to protect their stock position. That downside protection comes from the long put. So again, it's really the big part of the collar is that protected put, because that allows us to sell the stock at the strike price that we've selected. And then to pay for that protection, that's where the covered call comes in. The downside is that covered call, by selling it, again, as I mentioned, it gives us an obligation to sell stock at that strike price. So it's going to limit our upside participation, limited by that short call strike. The benefits of the collar is that that cost of the put may be free in a sense. By selling that call against it, that is going to help offset, as I mentioned, offset the cost of that put. And it could either offset partially or fully. There are things called a zero cost collar, or depending on the strike that we choose, both the long put and the short call, we may be able to even put this strategy on for a net credit. But the idea of the collar is that our objectives are met whether the share price goes up or down. If it goes down, we've got protection on the downside. If it goes up, we've got that short call generating some income for us to boost those returns. This last bullet point here, something key, is that any dividend received, if we're not assigned on that short call, because we are a stockholder, as long as we don't get assigned on that short call and have to surrender our shares, we're going to keep that dividend that is paid. And then the risk remains in the long stock up until that long put kicks in. So again, if we had a $100 stock and a $95 put and say maybe a 105 call, so long 95 put on the downside, short 105 call on the upside, we still have that risk anywhere from $95 up until 105 theoretically. So that risk is still with the long stock. So let's go ahead and look at an example here. Assuming we've got stock for $75 and we're looking at a 45-day expiration. So here's the scenario. We are cautious but bullish on our underlying stock price, trading $75. Over the next 45 days, we think there may be some fluctuations in the market for whatever reason, whether it's an aggregate market move or something specific to the stock, again, say an earnings release, something of that nature. We're willing to accept some downside loss, but we're not willing to accept anything more than 10%. So if we've got a stock price of $75 and we're looking to protect against the 10% move, it gives us 67.5, and that's the price at which we would be looking to exit our shares. If we look at our options change here, and again, this is 45 days out, we've got the various bid and asks for the calls at various strike prices, and same with the puts. We may look to buy the 67.5 put, which is trading $1.25, $1.35, because we're savvy investors. We're able to buy that mid-market for $1.30. And our short call, we're looking for something to offset this $1.30 that we paid. We could simply sell the 80 strike call for $1.30 and call it a day, but it may not give us enough upside participation, because remember, we're long stock at $75. So we could sell instead the 82.5 call at 87 cents. 97 is the market. We're going to get it somewhere closer to the bid, call it 90 cents. Our net debit for the trade, our net cost is going to be 40 cents. So rather than just buying the put outright and paying $1.30, we're able to significantly reduce our risk and reduce our out-of-pocket cost down to 40 cents from $1.30. Now, obviously, the trade-off is by buying this put, it still gives us that protection all the way down to zero, but it also affords us the ability to profit all the way up to, theoretically, infinity. By selling the 82.5 strike call, sure, it's going to reduce our out-of-pocket costs and reduce our overall risk, but at the same time, it's reducing our potential profit from infinity down to 82.5. So let's take a look at what that looks like. Again, long stock from $75. We bought that 67.5 strike put, which you can see right here. We sold the 82.5 strike call, which you can see right here. Net debit is 40 cents. So now our break-even point is going to be where we're long stock plus that 40 cents. So we've got a 75.40 break-even point. Had we just bought that put outright for $1.30, our break-even point would be $76.30. So almost $1 higher than where we are now. With this collar, we begin to profit on the trade sooner than had we just bought that put outright. Our maximum profit, you can see, is capped now, right? By introducing that short call, that is going to reduce our maximum profit from theoretically unlimited now to being limited at the strike price. So our maximum profit is going to be the short call, the $82.5, minus our share price, plus or minus our net debit. In this case, we've got a 82.5 call minus the share price of 75, plus the, I should say in this case, minus the net debit that we had paid. That would give us our maximum profit. Our maximum loss is going to work similarly, share price minus the long put, plus or minus the net debit, and again, our break even, in this case, $75.40. So there's a saying that I like to use when we talk about options, that the more moving parts there are of a machine, the more difficult it is to diagnose a problem with that machine and repair it. With the collar, now we've got three moving parts, right? We've got the long stock, we've got the long put, and we've got the short call. So managing a three-part complex trade is certainly going to be more difficult than managing a straight buy or sell, call or put. But there are basically three scenarios when it comes to the market, right? The market can go up, the market go down, or the market can stay the same. In the case of our long put, we're looking for protection should the market go down, and should it go down to a point where we're not comfortable maintaining the position anymore. So what if the stock price plummets? What is it that we can do? Well, we put the trade on simply for this scenario. So, it's almost like we were putting the trade on just in case we get in a car accident, and we did get in a car accident. So it's a good thing we've got that protection in place. Same thing with the shares here. If what we anticipated to occur occurs, well, maybe all we do is simply close the position, free up our capital by selling our shares at our strike price and moving on to our next trade. But also remember when I spoke earlier that because we bought that put, we are in the driver's seat. If we think that decrease in the stock price was only temporary, let's say stock went from $100 to $90, but we think that that was a reflection of maybe something market-wide, or maybe a competitor in the stock that we own, a competing company. Maybe they had bad earnings, something like that. The idea is maybe that dip in share price was only temporary. I apologize, folks. Maybe that dip was only temporary, and we have the ability to hold on to our position and choose what we want to do with it. Maybe we decide to hold those shares and maybe we sell that put back to the market. Or if we've got more time, maybe we just sit and wait what happens. Sit and wait to see what happens. Well, what if stock remains flat? Now it's time to reassess our trade. Do we still need that protection? Are we still bullish but cautious? Do we still want to have that protection in place? If so, and we're approaching expiration, we may want to roll out that position. We may want to close that long put that we have by a sell to close transaction, and then buy to open maybe 30 days down the road or 60 days down the road. If we still want that protection, if we're still cautious, maybe we're just looking to extend the time frame that we have it. What if shares rally? Well, if shares rally, we're not going to need that protection, right? We had that protection in place should share prices fall. But remember, we have that short call in place to pay for that protection. And that short call saddles us with the obligation to sell our stock if the strike price, or I should say if the share price approaches our short strike. So if we don't need that protection anymore, maybe we just close out the trade entirely, sell that put to close, buy that call to close, and now we're simply left with long stock. If we do want that protection to continue, we roll out both the call and put for more time. It all depends on what our forecast is going to be at that point. Which does bring up a good point. When it comes to stock, a stockholder typically is investing in stock may be a passive investment. What I mean by that is you buy the shares a lot of time, maybe stick it in your drawer and kind of forget about it. Or maybe you'll take a look every couple of weeks to see what the stock's doing and make decisions as you go along. But when it comes to options, an options investor, an options trader is a much more active participant. So each day, each week, each month, you're constantly looking at your position and you're reassessing what's happening, not only what's happening in the market, but what's happening with your forecast. If you're bullish today on the stock, am I still going to be bullish on it 3 weeks from now when my contract expires? So the idea is that you're reassessing your outlook, you're reassessing your objective. Has anything changed? And if so, you're going to manage the position accordingly. So if you want more time, you're still bullish but cautious on the stock, you may simply just roll out for more time as needed. So that's the collar as a whole. Again, that long put, that's going to be our exit price on the downside. Our short call, that's going to be our exit price on the upside should share prices rally and our stock get called away from us. But there are some variations to the collar that I think are really interesting. And again, this shows the flexibility and the versatility of options. So there's something called a staggered collar. So the idea, for those of you that are familiar with covered calls, and there's a strategy called a poor man covered call, where rather than being long stock and short a call, you're long a long-term leap option, a deep in the money leap call, and shorter termed regular calls. A staggered collar is kind of the same thing, where we may use a leap option to buy longer term protection and sell shorter dated calls against it. And the reason that we may do it is because these are all going to be variations. The cost of the trade is going to be different than if we were, to purchase stock up front and then buy the put and sell the call against it. Our risk of assignment, that is going to be the same, but it's going to have different ramifications because now we don't own the stock. Theta, time decay, for those of you that are familiar with the Greek concept of time decay denoted by theta, time decay is where the option loses value each and every day. So theta is going to be different because now we've got a long-term deep in the money call and a short-term, typically out of the money call against it. So theta is going to work differently against the position. And then same thing, the risk management that we just talked about, that's going to be a little bit different as well. So some advantages and disadvantages of a staggered collar, faster time decay. So that short option that we're going to have, that short call that we're selling against it, that is going to decay quicker than the long option. And again, the idea with the staggered collar is that we've got a long-term, deep in the money call contract, which closely replicates stock. And then against it, we're selling shorter dated calls. So we may buy a 2-year leap, let's say, and then sell 30 or 45 day calls against it. Every 30, 45 days, we sell another, we sell another, we sell another, et cetera, assuming that our calls are unassigned. If we do get assigned on that, that's going to be a different situation. But if our calls are unassigned, we may continue to keep selling those shorter dated options, generate additional income, lower our cost basis of the trade overall. Some disadvantages of it is that longer dated put that we're going to buy is going to give us more premium, which is something that we're paying for. The initial debit that we incur means that a large move in either direction is going to be a problem for us. It's going to, and ladies and gentlemen, I apologize, lost my train of thought again. Because we're paying more money up front for the option, if there is a large move in either direction that happens in the short run, we may have been better off with a traditional collar. And I think I misspoke for a moment ago. With the staggered collar, we still do have that long stock position. It's not that we're buying a deep in the money call to replace the stock. What we're doing is we're buying a long-term put, long-term protection. So I apologize for that. A touch of the COVID is creeping back into my brain. But again, the setup, and we'll see that on the next slide, the setup is that we've got our long stock position, but we're looking for long-term protection over the next 6 months, 9 months, 2 years, what have you. So we're buying a long-term put, and against that, we're selling short-term calls. So let's see what that would look like as an example here. Here's our scenario. Due to better expected earnings, we've enjoyed a run-up in the price of Bubble, a fictitious soft drink maker. We're long 100 shares of stock from 82. Stock is currently trading 96. Right, so we've already got a decent profit built into that stock position. So to protect some of those unrealized gains, protect some of those profits against, in this case, future earnings reports, we look to an options collar. So we could buy the long-term put, the December put, and let's say we paid $11.20 for that, and we're going to sell a shorter month call, shorter dated call. So in this case, we would sell the 100 straight call. So this long-term protection, we have the ability to sell our shares at $92.50 anytime between trade inception and December expiration. The short call in April, we're going to sell to generate some additional income and lower the cost of that protection. And the idea is that we're going to repeat that month after month after month, provided things go our way and we're not forced to give up the shares. So to lock in some of our profit, we are going to buy that long-term 92.5 put for $11.20. In the interim, we're going to take advantage of further share price increases by selling the April call, $2.75. We can repeat this again and again and again. For those of you that are familiar with covered calls, you may also be familiar with what they call the wheel strategy, or as I call it, a rinse and repeat strategy, in which if you get assigned on your short call and you sell your stock, now you take that cash, you buy a cash secured put. Now this is a different strategy, not the protective put, a cash secured put. You buy a cash secured put. If you get assigned on that, now you're long stock. You sell a covered call against it. If you get assigned on that, you buy a cash secured put, et cetera, et cetera, et cetera. And kind of the same notion here is that if you don't get assigned on those short calls and they expire worthless, you can simply sell another one and then another and another, as each sale reduces the overall cost of that long-term put. And then again, that short-term theta works in your favor because we are buying a long-term put and we're selling a short-term call as well. That long-term put, because it's long-term, that theta is going to decay the value of that contract at a slower rate than the theta decays that short-term call. So the call that we sold is going to decline in value quicker, which as a seller is what we want, than the value of that long-term put. So selling those short-dated calls benefits us in this way because theta is working in our favor. Some of the different risks that may be involved, we had mentioned earlier, what happens if stock makes a big move. If stock moves sharply lower, maybe we exercise that long put early or we sell it back to the market. If we sell that long put, or I should say if we exercise that long put, we're going to be foregoing any time value that might be left in it. And if we're talking 6 months or 9 months down the road, there still might be a good deal of time value left in it. So while we could exercise that put and sell our shares if we wanted to, we can also simply sell that put back to the market and maybe collect a larger amount of premium and then sell stock at whatever that current market price is, if that's our choice. Or we may decide to hold that put, because remember, we had talked about you've got, with this long-term put, maybe we've got 9 months. So sure, shares drop today or they plummeted next week, but we still have another 9 months to go until our long put expires. And again, 9 months is just an arbitrary number I'm pulling from my head. But the idea is we have no idea what's going to happen in that 9 months. We will always retain that right to sell that stock over that 9-month period. So we may not want to sell our shares tomorrow if the bottom falls out of the market. Maybe we hold it and see what happens. So again, definitely something that as a buyer of an option, you're in the driver's seat, you control what happens next. If the stock moves higher, likely we're going to get assigned on that short call. If we don't want to get assigned on that short call, maybe we roll that call out for more time. Maybe we roll it up to a higher strike. Maybe we do a little bit of both. Either way, we are in control. We decide what happens. A variation that of the collar is something that I really think is interesting. Is called the put spread collar. With our typical standard protective put, whether it be part of a collar or just by itself, we've got protection. We are paying for protection from our strike price all the way down to zero. But if we can fine-tune our forecast, we may think that the likelihood of that stock going to zero is minimal or not likely at all. You can see here I've got what is the likelihood of the stock plummeting to zero. If we can fine-tune that protection, we might be able to save some money. And think about from a simple point of view, think about a long call option that gives us the ability to profit unlimited, right? The stock can theoretically go to infinity. Now, I've been in the business 25 years, and I have yet to see a stock go to infinity. So why pay for all of that upside possibility when you really don't need it? The likelihood of a stock going from $100 to $10,000 is significantly less likely than the stock going from $100 to $120, which is one of the reasons that a lot of traders and a lot of investors love spread trades, because they're limiting their range of profit because they don't think anything outside of that range is likely. And the put spread collar kind of works similarly. The idea being is that we only have protection for the range in which we think we need it. So we've got our long stock, we've got a short out of the money call, long out of the money put, right? That's our traditional collar. What if we sell a shorter, further out of the money put against it? And let's see what that looks like. We've got 100 shares of Jogger. Our investor here, Karen, bought 100 shares 2 months ago. She feels there's long-term protection, but is concerned with upcoming earnings and is looking for protection in the downturn. Protection in the short term. Now, here's what's important. No matter what happens, though, she does not anticipate a large decline. So she could simply buy a protected put, which we talked about last week. It may be expensive. Protection is expensive. Certainly out-of-the-money protection we've seen historically is more expensive than out-of-the-money calls. She could place an options collar around the position, which would provide protection all the way down to zero. Or because she doesn't anticipate the potential decline to go to zero, but rather a modest one, she's thinking maybe trade a put spread collar. So here's our setup. Again, we're long 100 shares of stock from 105. Stock's currently trading 120. Here's our traditional collar. She is going to buy the 45-day 115 strike put for $3.60. This gives her the ability and the right to sell her stock at $115 a share. To offset the cost of that, she's going to sell a out-of-the-money call at the $125 strike for $3. She's got a 60-cent debit. She's paying 60 cents for this protection. That's the net debit of the two. She's giving up any upside participation beyond 125, okay? Now, if she felt, and remember this was our setup, that she felt that decline would be a modest one or maybe only a temporary one, she could sell an additional lower strike put, in this case the 105 strike put at $1.60. And what that does is it gives her protection on the downside from $115 down to $105. But anything beyond that, and we can see here's $115. This is where the protection kicks in. She would, if stock finished at 115, we would lose $2 on the put spread. The short call would be worth $3. Our long stock, we bought it for 105. It's now trading 115, so we're long a $10 profit on that stock. It gives us a net profit and loss of $11 profit. That's with stock at 115. If shares decline down to 105, we still have that protection, right? We still have that ability to sell stock at 115. This is where their protection kicks in between these two strikes. Anything below that, if shares finished at $95, for example, we are going to begin losing money again. And the reason being, and you can see it better here in our graph, the reason being is this is where our protection is between these two strikes. If share prices were to fall below that, we would end up selling our stock at 115 through exercise. We would end up likely buying stock as a result of our short put through assignment. So we're selling at 115. We are buying at we're buying at 105. Now we've got a long stock position because we're already long stock from, remember, $105. So we sold that stock at 115, but now we're forced to buy it back for 105. So now we're long stock, and we've got all the risk that goes along with it. If we put this trade on, we go from buying the put protection outright for $3.60 to buying the collar for 60 cents. Now we've got that protection that might be all that we need, and we're actually getting paid to put this trade on. We're doing it for $1 credit. So our maximum profit is going to be our short call strike of 125 minus our long stock plus that net premium of 21, or the $1, I should say, for a $21 profit. That's where we're going to be here. So no matter how high shares climb above 125, we are going to top out at this $21 maximum profit. Our maximum loss now is going to be considerably different with the put spread collar because we no longer have protection outside of that short put. Our protection exists only between those two put strikes, which means that our maximum loss is now going to be whatever our cost basis is. We were long stock for 105. We sold the put spread collar for $1. Our cost basis is now 104. The width of that put spread is $10, so we've got a potential loss of $94 a share. So you can see, obviously, rather than that protection all the way to zero, we're only protected between these two strikes. Still, I think it's a pretty amazing trade in the sense of, again, if you have an idea of where those shares might fall to, why pay for protection all the way down to zero when you may only need it down to 105? So just something to think about, another idea, another quiver to put, or an arrow to put in your options quiver. A good idea and a protection strategy that I think a lot of investors get a benefit out of. Now here's the last one that we're going to talk about today, the laddered collar. And what a laddered collar is it kind of combines the staggered collar in the sense that we've got a long-term protection, but rather than selling one option against it and then that expires and then selling another one and selling another, we're going to sell options throughout the life of our protection. So in this case, long 100, stocks trading 100, we're long 500 shares. We're going to buy 5 of the 85 puts, the 180-day 85 puts for $4 each. So this gives us protection from $85 all the way down to zero on all of our shares for the entire 9 months. To pay for that protection, we can sell any variety in any variable, any strike price, any expiration date, et cetera, that we choose. But what we're looking to do is almost like a ladder. We're going to have steps. So we're going to sell a 30-day option at the 105 strike. We're going to sell a 60-day option a little bit higher, a 120-day option a little bit higher still. And the idea is that we are looking to provide the stock with room to breathe should it keep increasing, over the next 180 days, over the next 9 months. Remember, we're bullish on the stock. We want the stock price to go up. But if we choose a strike price too low for our short call, well, we may end up losing those shares sooner than we would like. So this way, it gives us some breathing room. It gives us a wider range of potential stock prices as time goes on. And then when you add all of these up, it gives us a net debit of just about $1,200 when we factor in the multiplier. So what ifs? Position management. What if stock makes a sharp move in either direction? Well, if it goes down, again, we've got their protection in place. It's the whole reason that we put the trade on to begin with. We may decide to exercise that put and simply close out our short calls. If there's a sharp move up, some of those short calls may be assigned. Typically, the nearer termed ones would likely be assigned, and some of our stock would get called away. That might be fine, but again, we have the ability to manage that position if we want. If we wanted to extend those short calls because that's where our risk is going to be, we can certainly roll those out, roll those up, or a combination of both. In either case, the premium that we collect for those shorter dated calls versus the longer results in less overall profit from a big move. And what that means is if I sold a 30-day call for 75 cents, but I could have sold a 180-day call for $4, and I get assigned, I'm still delivering that stock. The difference is I only collected 75 cents up front to sell my call rather than the $4 that I could have collected, which would have given me a higher profit potential. So key takeaways. We've got the options collar. Again, it's a combination of the two spreads. For protection, it's the long put. For the short call, it's going to be that covered call, and that's going to help us offset that cost. From the long put, it's giving us the ability to exit our stock at the strike price. From the short call, it's going to limit our profit potential, but it's also going to offset the cost of the overall trade. The variations that we covered was the staggered collar. That was where we bought a long-term put and sold a short-term call against it with the idea that we would repeat that possibly month after month. The put spread collar, where we've got protection simply within that strike range. In the example, I think we had the 115 strike put versus the 105 put, so we've got protection in that range and in that range only. And then the laddered collar, where we've got our long-term put, and then we sell a short-term call, maybe medium-term, long-term, et cetera. We spread out the range of sales for that ladder collar. But each one of them presents different advantages and disadvantages. There is information on our website about the options collar. We have past videos and webinars that we've done on the variations as well. So if you're looking for more information, definitely get in touch with us. Visit our website. Here's some contact information for you. Optionseducation.org is going to be our website where you can live chat with us, as well as access OCC Learning, which is our online, interactive online courses. And like I mentioned, we've got a new course that we're very much happy to launch at the end of the month. Certainly hope that you'll like it. Investor education, the pride and joy of OIC. You can reach us via email, options@theocc.com, and then please follow us on social media.